Today on our show for the SIE exam, we will cover exchange-traded funds, commonly known as ETFs. These investment products are incredibly popular, and you absolutely must understand their structure and key features for the test. An ETF is a basket of securities, such as stocks, that tracks an underlying index, but it trades on a stock exchange just like a single stock. This is a primary distinction from a mutual fund. While a mutual fund calculates its net asset value, or NAV, only once at the end of the trading day, an ETF has a share price that fluctuates throughout the day based on supply and demand. This allows investors to buy and sell ETFs at any time during market hours using the same types of orders they would for a stock, like limit orders or stop orders. This feature, known as intraday tradability, is a major testing point. The exam might present a scenario where an investor wants to react to market news immediately. The ETF is the appropriate choice over a mutual fund in that case. Now, let's get into the mechanics that make ETFs unique, which is the creation and redemption process. This is the source of their famous tax efficiency. It involves large institutional investors known as Authorized Participants, or APs. When there is demand for more ETF shares in the market, an AP can go to the ETF issuer and deliver a basket of the underlying securities that the ETF is designed to hold. In return, the ETF issuer gives the AP a block of new ETF shares, which the AP can then sell on the open market. The reverse is also true for redemptions. If there is heavy selling pressure, an AP can buy up a large number of ETF shares from the market and return them to the ETF issuer. In exchange, the issuer gives the AP the underlying securities from the fund's portfolio. This process is the secret sauce to the ETF's tax advantage. Notice that in both creation and redemption, the ETF issuer is not buying or selling securities for cash. The exchange is done in kind, meaning it's a trade of securities for ETF shares. Why does this matter? When a traditional mutual fund manager faces redemptions, they often must sell securities within the fund's portfolio to raise the cash needed to pay the redeeming shareholders. This sale can trigger capital gains, and under IRS rules, those gains must be distributed to all remaining shareholders at the end of the year, creating a taxable event for everyone, even for investors who didn't sell any shares. ETFs largely avoid this problem. Because the authorized participant simply receives the underlying stock in an in-kind redemption, the ETF manager doesn't have to sell anything and therefore doesn't generate a capital gain within the fund. The tax liability is effectively passed on to the AP. For the average investor who simply buys and sells the ETF on the secondary market, they will only face a potential capital gain when they decide to sell their own shares. They are insulated from the trading activity of other investors in the fund. A common trap on the exam is to misunderstand this mechanism. The SIE loves to test the differences in tax consequences between fund types. Just remember this simple phrase to keep it straight. In-kind is kind to your taxes. This shortcut helps you recall that the in-kind creation and redemption process is what makes ETFs so tax efficient compared to their mutual fund counterparts.